Revenue just broke $80 billion. Earnings beat expectations across the board. Yet the stock plunged nearly 20% after the report. So what exactly happened to Microsoft? Has the AI narrative started to fall apart? Or did the staggering $100 billion spending plan simply scare Wall Street away? With a long-term price target of $678 on the table, is this pullback the bursting of an AI bubble or a once-in-a-decade buying opportunity? Hey everyone, welcome to Stock Market Breakdown. Microsoft's recent price action has many long-term investors on edge. Revenue and profits are still growing, yet the market isn't impressed. The real issue isn't how much Microsoft earns, it's how much it's spending. A $100 billion capex plan is one of the boldest bets in modern business history. Looking at the actual financial results from fiscal year 2026 Q2, Microsoft delivered what could only be described as an outstanding report. Revenue reached $81.03 billion, up 17% year-over-year, while earnings per share came in at $4.14, both beating market expectations. However, that excitement was completely overshadowed by another number. Microsoft announced plans to invest more than $100 billion in capital expenditures in 2026. The market reacted with extreme anxiety, worrying that such astronomical hardware investments could significantly erode future profit margins. As a result, the stock experienced an almost 20% sell-off after the earnings release. Wall Street hates uncertainty, and a $100 spending plan pushes many investors out of their comfort zone. But one fact stands out: Microsoft's revenue is still growing at a double-digit pace. The recent drop is really the market digesting a valuation reset as Microsoft moves into a heavier infrastructure investment cycle. This massive $100 billion investment is not simply a marketing expense. It's being used to build the AI infrastructure that could support the next decade of growth. Microsoft is placing a massive bet on what it calls agentic AI, a new generation of AI systems that not only generate content, but can actually execute tasks across applications. Microsoft believes that only an enormous base of data centers and computing capacity can support this transition from simple chat interfaces to autonomous execution systems, potentially triggering a new multi-year AI supercycle. Many asked if massive data center spending is worth it. Such an Adela's view is clear. The next phase of AI isn't about poems or images, it's about digital workers. Agent-style AI needs massive compute. Microsoft's investment today is like buying land and building highways for the AI economy. Within Microsoft's vast ecosystem, Azure has become the central flywheel powering the entire strategy. With quarterly revenues surpassing $50 billion, Azure has demonstrated an extraordinary ability to integrate multiple services into one cohesive platform. Copilot, security tools, and developer platforms are tightly connected. The widespread adoption of Copilot drives increased usage of Azure's cloud resources, while that increased cloud usage generates more enterprise data, strengthening customer lock-in. This positive flywheel effect gives Microsoft enormous ecosystem stickiness and pricing power. When competing against AWS and Google Cloud, Azure isn't just running servers anymore. It's now a full AI-era operating system. Once companies adopt Microsoft's AI tools, they're locked into its storage and compute. This software drives hardware. Hardware locks software. Flywheel makes Microsoft's recurring revenue extremely resilient. To offset the growing pressure from massive capital spending, Microsoft has introduced its own AI accelerator, the Maya 200. This chip is specifically designed for inference workloads inside Azure data centers and marks Microsoft's official entry into vertical hardware integration by reducing reliance on external chip suppliers. Maya 200 has the potential to improve performance per watt while significantly lowering long-term operating costs. This kind of structural cost optimization could become Microsoft's strongest financial defense As AI moves toward large-scale commercialization, the launch of Maya 200 marks a major evolution in Microsoft's financial model. Buying NVIDIA chips sends profits to others, while using in-house silicon keeps them in-house. Inference tasks drive most AI costs, and even partial replacement with Maya 200 creates huge margin buffer for Microsoft. From a valuation perspective, Microsoft is currently trading around $393 per share, which corresponds to roughly 24 times forward earnings compared with its historical valuation range and its powerful free cash flow generation. This multiple reflects the market's confidence in Microsoft's execution rather than speculative excess. After the nearly 20% pullback, Microsoft's valuation has returned to a much more attractive level considering the company's enormous recurring revenue base. The current price presents a fairly compelling risk-reward profile. Buying Microsoft at 4xp would have seemed unimaginable just years ago. Remember, this is one of the world's most cash-generative companies. The current valuation has largely priced in the 100 spending risk if you believe AI demand holds. This multiple actually offers a built-in margin of safety. Analyst sentiment remains overwhelmingly optimistic. Among the 50 analysts currently covering Microsoft, the average rating stands at 4.72 out of 5, nearly a perfect score. Most analysts argue that the recent weakness in the stock is driven by temporary investment expansion rather than any collapse in demand. The company's double-digit revenue growth provides strong evidence supporting that view. The highest price target currently sits at $678, implying roughly 73% potential upside from today's levels as long as Microsoft can demonstrate that its massive investments translate into sustained Azure revenue growth. Its long-term upward trajectory should remain intact. In summary, Microsoft is in a critical profit-for-future window. The 100 spending may spook the market, but Azure's flywheel, cost-saving Maya chips, and strong demand all support its $678 long-term vision. That's it for today. I'm Stock Market Breakdown. See you next time.